You want to build up equity. You want to grow your net worth. You want to accumulate more and more and more. What happens is you start to assume that the reward you're getting comes without risk. And then one little thing changes, the wind blows and your pyramid topples over. Hey there, I am David Green, and in this video, I'm going to teach you how to manage risk in your portfolio while making sure you become even more profitable with every purchase. Here's something I know. Every single investor always starts off the same way. They want to know, how do I get cash flow? They really want to get a return. They're learning how to use calculators. They're learning how to analyze properties. They're really scared, but they're really excited. And they talk all about what they want to become. Now that typically takes the form of, I know how to do this one thing. I just want to do it over and over and over and over again. It's really cute. This is what everyone does. And then at a certain point, when you actually are doing it over and over again, you realize, I don't want to do this over and over and over again. This is where Brandon Turner's theory of the stack comes in. So Brandon makes this whole idea of real estate investing and growth and kind of makes it simple. He says, buy a property, next year, buy a duplex, next year, buy a fourplex, next year buy an eightplex, and you're always doubling. So you're able to scale consistently, but you're not going so big that it would be too hard. It's really good advice for newbies to consider as they progress through their journey. Today, I'm going to be tackling how you consistently get bigger, better, and more productive deals without toppling from all the risks that can come with those types of properties. Now, as you grow, what you find is that stuff that used to excite you when you were new doesn't really do it for you anymore. That $90,000 property that meets the 1% rule, the duplex that you can put two people in that you're so excited about, starts to become kind of draining when you're constantly dealing with the tenant issues. What you find is the reason you got into real estate is usually not the reason that you stay in real estate. And this is normal. This is what causes growth. People go after different types of properties because they have a different purpose. A few things that I noticed as I was growing. I noticed that reward and risk are tied together. Now, as I grew in wealth, there started to become a point where certain deals, even if I was successful, didn't make sense for me to go after. They were just too small. So I hit a minimum of the type of deal I would have to go after that would have enough meat on the bone, which meant the problems I was facing became bigger and bigger and bigger. It forced me to grow. I learned that higher returns are more volatile, that there's a lot of real estate, like flipping really expensive luxury property, where people were making several $100,000s on a flip. But if your ARV was off by a little bit, you thought you were going to sell it for $3 million and you sold it for 2.7, you might actually lose money on those deals. I also learned that too much of the same property could become burdensome. I scaled to about 40 single family homes using the Burr method, and I hit a point where I realized I don't want another one of these single family homes. The juice just wasn't worth the squeeze on that berry. Another thing that I noticed, as people grow in their investing profile, defense starts to become more important. Now, when you're new, it's all about offense. You want to build up passive income, build up cash flow. You want to build up equity. You want to grow your net worth. You want to accumulate more and more and more. Then once you have a lot, it changes and you think, I want to keep what I have. I don't want to lose what I've already accumulated. And you start thinking about defense. Instead of just looking at the return, you can easily start looking at what's the safety in that property. All right, if you're liking what you're hearing so far, please do me a favor, smash the subscribe button and make sure you hit that like button. All you got to do is take a quick second, take your finger and like a ninja, smash on that thing. YouTube wants to know that you like this type of content, and I'm making it because you like it. So please do me a favor and do that so I know that I should keep making it. Now, what I want to share with you today is the method that I use to play consistent defense so I don't lose money with a high-powered offense so that every deal I buy ultimately ends up making me more money than the one before. I had to earn the right to go after bigger rewards. Let me break it down for you. I've got this model and it looks like a pyramid. All right, as you can see here, at the base of the pyramid, you have low risk and low reward. Now, the base of the pyramid is the biggest part. This is the sturdiest part. This is why pyramids don't fall over. So here's the principle I live for. The majority of the work I do will be in conservative investments. Now, let me give you some example of what conservative investments might be. Small multifamily properties that cash flow really well, but don't have a big upside as far as appreciation. Single family homes in good neighborhoods that I didn't do huge value add to and that are going to go up slowly over time. Earning income through real estate commissions. It's not sexy, but it's safe. You don't lose a ton of money if you're good at being a real estate agent. You just don't make as much. It's low risk, low return. Now, just like you, I don't want to just make a low return all the time. I want to take some swings at some big stuff. So what you find is that you go up this pyramid that I've created into something that's a little more risk and a little more reward. Being a real estate agent was very safe, very low risk. Hiring employees and building a real estate team became riskier. Now that I have salaries, fixed costs, other people I have to pay to train, there is more risk associated with this endeavor. I'm putting more money into this business, but my reward is higher. I also bought different properties. I go into higher price points in better neighborhoods. What I didn't do was go bet $1 million on a Powerball and go right to high risk and high reward. So after you get enough of the properties that are in better areas that have better upside but a little more risky, now maybe you take a step up into short-term rentals. Those are much more riskier than small single-family homes. If you can't use it as a short-term rental, or if nobody books it, you may not be able to cover your monthly mortgage based off just a traditional rental. You're going to spend a lot of time with cleaners and handyman, and what if you get a bad review on Airbnb and your rental drops down the bottom of the listings page? Now, as you can see, different asset classes scale like this. You can get into bigger and better stuff. You can start to buy big commercial properties. Those have a really big upside. If you can increase the rents and keep your expenses the same or lower them, you can add a lot of money. But they're very risky too. Everybody needs a place to live. Not everybody needs a place to work. Now, ultimately, you get to the very top of the pyramid. That could be flipping expensive homes. That could be investing in cryptocurrency. That could be raising other people's money and putting it into real estate. All of those are higher risk and higher reward activities. Here's how you do that safely. You only do it as much at the very top as the base below it can support. So if you lost all your money at the top, the level below it would still support you and you'd break even. You have to be disciplined because what everyone wants to do is start at the bottom and scale up like a skyscraper as quickly as possible. And if you're not careful, you'll have a very thin foundation and you will expand upwards to higher risk stuff. And as you do that, you'll be taking more and more and more risky investments so that your foundation of safety and conservatism is small. I'm disciplined. I only let myself take shots at bigger properties if I have more of the conservative stuff going on. So every time I want to add something to my portfolio that's risky, I got to add a couple others that are conservative. There's different ways that people are making money right now, and it can feel easy. What happens is you start to assume that the reward you're getting comes without risk. And then one little thing changes, the wind blows and your pyramid topples over. So if you can take this principle and apply it to whatever it is you're buying, you won't ever have to worry about actually losing your portfolio. Every time you want to do something at the top of the pyramid, make your base wider at the bottom. Be disciplined, be smart, buy the right kind of properties, and you won't have to choose between one or the other. You can have a safe portfolio and take some really big shots that make you really good money at the top. All right, thank you very much for joining me. Appreciate your time. I hope you're able to apply this into yourself so you can invest with confidence and with aggressiveness and boldness and assertiveness, but still be conservative. That's my style. If you've got a minute, check out one of my other videos. And if you can think of anyone to send this to, please do.